But we're getting through most of the selling pressure. Markets are getting fairly deeply oversold here. We're exhausting sellers at this point. Sentiment's turning much more bearish, which is what we needed. So we're reversing a lot of this exuberance that we had in the markets. So here's what you need to know before the bell, by the way. As we talked about yesterday, this correction actually started. This correction didn't start on Monday. This correction started back on the 15th of July, where the market peaked. We began to sell off, fairly normal sell-off in the markets, nothing really exciting too much. Came down, took out the 20-day moving average, held support at the 50, challenged the 20 and failed. And then when we failed at the 20-day moving average, that's where the market began to really experience these sell programs, and we began to see the impact of this unwinding of this carry trade beginning to happen. And it happened very quickly. So we crashed through the 50, the 100, and was approaching the 200-day moving average. We haven't quite got there yet. But then we said on Tuesday, don't be surprised to see a reflexive rally here, challenge this 100-day moving average, and then these trap longs, these people that got swept up into this sell-off, don't be surprised to see them hit the exit button. And that's what they did yesterday. The market rallied right into the 100-day moving average, briefly poked above it, but then sellers showed up and basically had selling all afternoon yesterday as they sold off, and markets ended at their lows yesterday. So again, kind of expect a little bit more of a sell-off, potentially today or tomorrow. But we're getting through most of the selling pressure. Markets are getting fairly deeply oversold here. We're exhausting sellers at this point. Sentiment's turning much more bearish, which is what we needed. So we're reversing a lot of this exuberance that we had in the markets. So as we reverse that exuberance, that's going to give us a better opportunity to potentially see where this market bases and stabilizes, and we'll kind of know if and when we've got a market bottom put into place. One other thing we said also is to pay attention to bonds. This is bond price, not yield, but bond prices got just shot off through the roof on concerns about recession, right, from that employment report that was a bit early, very kind of overly exuberant. And we noted that we would have, we said earlier this week, we said, don't buy bonds here. It's too late. If you're not in bonds, you can't buy them here. They're too overbought, too extended. We're now working that off. So again, we would expect to see bond yields kind of come back, or bond prices to come back to basically the support, this cluster of moving averages that we have right here. That's about 4.1% on the 10-year Treasury. We were about 3.95-ish yesterday. So we're getting back there. We've got a little bit more work to do here. We're not oversold yet on bonds, so we don't quite have an entry point on bonds, but the bullish setup for bonds in general has become much better recently. And as the Fed cuts rates, that will continue to put downward pressure on yields and push bond prices higher. But it's not going to happen overnight. It's not going to go straight up. This is going to be kind of a grinding process here for a while. So that's what you need to know before the bell this morning.